Hi, I'm MaryAnn. Turbulence, we saw a lot of it this week with the Fed meeting minutes, but is there more ahead? And what does it mean to us as investors? I'm joined by Derek Burleton, who's Deputy Chief Economist at TD Bank Group. So it was a pretty volatile week this week. Fed meeting minutes did a lot to move the market. What was such a big deal that the dovish comment didn't really seem that big to me?
Well, there were many in the markets that thought there was a chance the Fed might change its guidance language, and the markets have been rallying in recent months on this notion. The Fed's not going to do anything for a considerable period of time, but we do know that within the Fed there's a lot of debate. You've got the hawks that think the language is too relaxed. You've got the doves that would like to err on the side of caution and keep conditions ultra accommodative for that considerable time. At the end of the day, they didn't change it. I think one of the concerns was if they did change the wording, the markets may not respond well to it. At the end of the day, what the Fed does is going to be completely driven by how the economy unfolds. And in our view, the conditions won't be right for rate hike until at least midway through next year.
So it sounds like there's more volatility, though, in that Fed decision, or more controversy, like back and forth and debating, than you would expect. How does that play out in the longer term when we look at interest rates?
Well, and you're right, and to carry on with that volatility theme, because we clearly, after having a lack of volatility for the better part of this year, things have really become much more volatile of late, and it's likely we are in a period of higher volatility. I think as we go forward, I don't think certainly getting consensus is going to be a real challenge, and that's clear from this week's statement. And I think that adds to how the markets are reading. Obviously, what the Fed does is key. What's going on globally is key in terms of Japan and Europe. Just a lot of mixed signals right now. And so the Fed is obviously going to be key in terms of market trading, and as we move forward. And as I say, certainly the scope for further fireworks there.
Now, what about global growth concerns? That's kind of been another big factor out there. Is that real? Is there enough issues out there in terms of China, Europe, Japan?
There is. There are four major economic engines globally: the United States, Europe, Japan, and China. And three of those engines have been sputtering lately. Europe, concerns about another recession, with Germany flatlining lately. In Japan, growth began the year like a bit of a lion, has since faded back, and concerns that some of the policies that have been implemented won't take Japan to the next level and arrest deflation. And in China, concerns about the property market there and some of the weakening. So yeah, these are really have been key drivers of the market late. I think on the bright side, the United States has been, for the most part, matching some of the reasonably optimistic forecasts this year. But I think there's some question as to whether weakness among these other engines is then going to affect the United States and slow it down. I don't think it will. I think one of the things that we do know about the U.S. is a lot of its growth is driven internally. It's domestically. It's not driven as much by external demand. And I think there's enough momentum within the U.S. to help offset some of the softness in these other areas. And in fact, with weaker currencies against the U.S. dollar, that'll help some of these other regions pick up a bit as we move into 2015.
So specifically, obviously, with Canada, the U.S., a huge factor in everything that we do and affects us largely. What about our loonie? Where do you see it going? Is it going to be weighed down by all these other concerns?
Well, Canada's economy has actually done reasonably well. The Canadian economy has hitched its train to the right part of the world at the moment with the U.S. It's helping exports. It's filtering through to decent growth. I mean, it's not a boom this year, but growth of around 2.5–3% as we move through 2014 into 2015. And I do owe some of that momentum to a weaker loonie. We have seen it pull back quite a bit on a trend basis. And, the fact is that the U.S. dollar is king at the moment, and I don't see that subsiding at least over the next few months. We do see the Canadian dollar losing some ground, and if anything, that's going to help Canada's economy in terms of growth in 2015.
So what's your forecast for the loonie then?
We've got it bottoming at 87 U.S. cents. In recent days we've seen a little bit of a rebound, but things don't happen in straight lines. Again, it's not so much a Canadian story as it is a U.S. story, but commodity prices haven't been helping the loonie. They fell about 10% in the third quarter, and right now there just seems to be a a real pessimism around commodity markets. One thing about commodities, though, and I think that'll support at least some stabilization in the loonie as we move through 2015 and lead it bounce back to about 90, is that commodity prices can only go so low, barring a real nasty situation globally, because the costs of producing are high, things like oil. So there's a bit of a limit as to how far they can fall on a sustained basis. So we don't have commodities losing a lot of further ground, and same thing with the Canadian dollar. At some point we will hit a bottom and it will rebound.
So is this good for exports then in general, the fact that the loonie's going lower? You know, if oil prices, gold prices don't go too far down, then we're all right looking ahead?
I think so. I think the loonie, again, I think this is supportive. I think no qualms for the Bank of Canada. Loonie's losing some ground. I think that's good. If your U.S. dollar commodity prices are losing ground, that helps resource producers. When they convert back into a weaker Canadian dollar, that helps them, helps manufacturers, helps a lot of Canada's economy deal with some of the pressures globally. So I certainly, that would be, I think, a positive thing for Canada's economy, to see the dollar lose another few cents. Certainly if you're an investor, it's something to factor in. But I just see the momentum behind the U.S. dollar being key at the moment. I don't see that subsiding over the next couple of months as we end the year. And then at some point, as we move into through the first half of 2015, you'll get a bottoming in the U.S., a peaking in the U.S. dollar, and other currencies then rebounding a bit against it.
Okay. And now in the report, you also said housing market and household debt present an upside risk to the forecast. So why is that?
Well, in the near term, I think we've seen what we saw as housing beginning the year on a very weak foot across Canada's key markets, and as the years progress through the spring, it's rebounded a bit, and I see some momentum there. So yes, there have been a lot of calls for housing to slow, and I still believe it's going to happen. But if anything, I think it's been pushed back to next year when rates begin to grind a bit higher in Canada, bond yields begin to rise, mortgage rates follow suit. So cooling, yes, but it's not a story for this year. And in the near term, that's going to give spending a lift. We're going to wait and see. I think household debt will rise a bit further, and that's something to keep our eye. I do.
Yeah, okay.
I mean, there's more caution. We don't expect mortgage growth to really pick up hugely, but a little bit of an uptick in light of stronger home sales, I think, is in the offing. It's a concern, though. I mean, we do know that debt levels are still high, and what that does is just put a bit of a longer-term risk around Canada. If things got messy, there's a vulnerability there, but I don't see that being a near-term hindrance to Canada's economic performance.
So what would turn that around, the household debt situation?
Well, I think this is one of these stories where unless unemployment were to spike quite a bit higher, interest rates were to spike, we don't expect to see a major change. But as interest rates do grind higher, every quarter point's going to matter for households. And so we wouldn't expect debt growth to grow by more than incomes, which is fairly modest. And on that count, we don't expect to see a major pickup. But, as I say, we are watching it, and so too is the Bank of Canada and the federal government. And if we do get a real spring back, they'll probably take more actions to regulate mortgage insurance or impose other regulations to slow down that debt growth.
Okay, and related to that, jobs, you also mentioned above average productivity growth is what you're expecting. So wondered, what exactly does that mean for wage growth? And then what about those actually going out there looking for a job?
Well, it's been a bit of a disappointing performance, at least in terms of job creation this year. But the corollary of that, the flip side, is that productivity's done quite well. We've seen good output growth in Canada, very little employment, and that's what spills out. And so it's not a bad thing. I mean, we know over the long run that wages are set by productivity efficiencies. But going forward, I think the view is that employment will gain some ground. I think that's what tends to happen. You get real GDP picking up, and then employment tends to pick up in lagged fashion. So look for better employment gains. Wages, it's an international phenomenon. Wage growth is it's constrained almost everywhere, and I wouldn't expect to see wage growth pick up hugely. But over time, to the extent these productivity trends, at least some of it sticks, then I would expect some moderate acceleration in wage growth over the next few years.
All right, lots to think about, definitely, as we look at our portfolios in the coming few months. Well, thank you very much, Derek.
Thank you.
I've been joined by Derek Burleton, who's Deputy Chief Economist, TD Bank Group. Thanks for watching.